10 years ago, I made a mistake that looked small, but it cost me a lot of growth. I didn't lose money in a scam. I didn't pick some crazy stock. My mistake was quieter than that. I kept looking at other people online. He turned $10,000 into $50,000. She retired at 35, and I started feeling behind. So I kept changing things. I kept second guessing. I kept thinking I needed a smarter move. Here's the weird part. My first ETF investment still did fine. It roughly doubled. Most people would call that a win, but it didn't feel like a win because I couldn't stop thinking, what if I did it the right way from day one? And I'm not talking about picking a different fund. I'm not talking about timing the market. The real issue was my habits, the stuff nobody posts screenshots of. I also believed a big myth. I thought compounding feels smooth, like a nice steady climb, like the charts you see in retirement calculators. But real life doesn't feel like that. Real life feels like one step forward, then two steps back, then a jump, then a drop. And if you're not ready for that, you will make the exact wrong move at the exact wrong time. So in this video, I'm going to walk you through what I learned after living through real market years. The good years, the ugly years, the I want to quit years. And I'll share the 7 lessons that changed how I invest, and honestly, how I think. These lessons are boring. They are not flashy, but they are the reason compounding works for some people and doesn't work for others. Quick disclaimer. I'm not a financial advisor, and this is not financial advice. It's just my personal experience. Please do your own research before making any investment decisions. I'm Mark, and this is Dividend Hustle. Now let me take you back to the moment I made that first ETF buy and what I wish I understood right then. 10 years ago, I made my first ETF buy. I still remember how it felt. It felt like I was doing something adult, something smart. I thought it would be simple. Put money in, let time do the work. Then one day, I'd look up and see a smooth climb, like those clean retirement charts that always go up and to the right. But real markets don't move in a straight line. They don't care what you expected. They go up, then down, then flat, then up fast, then down again. And the hardest part is this. The story in your head changes with the price. When your account is green, you feel calm. When it turns red, you start making up scary stories. You start asking, did I mess up? That's where most people get pulled off track. Over time, I've learned there are really 2 types of investors. The first type is what I call the guessers. They guess when to buy, they guess when to sell. They guess what fund is best this year. They guess based on feelings and headlines. The second type is system builders. They set rules, they automate, and they stick to the plan when it feels boring and when it feels painful. The market rewards system builders more often, not because they're smarter, but because they stay consistent. Quick note before we go further. I'm not a financial advisor, and this is not financial advice. I'm just sharing my personal experience and the lessons I learned. Please do your own research before making any investment decisions. Now let's talk about the first lesson that hit me harder than I expected. Compounding looks pretty on paper, but it can feel rough in real life. On paper, it sounds clean. Invest $10,000 at 10%, and in 10 years, you have about $20,000. Easy. But in real life, you don't get that smooth ride. You get years that feel amazing and years that feel like you're going backwards. My friend Mike learned this the hard way in 2022. He had been investing for about 5 years, mostly in broad market ETFs like VTI, Vanguard's total stock market ETF. His account had grown nicely in the good years. Then 2022 showed up and punched him in the face. VTI dropped about 20% that year. Mike watched years of progress shrink in a short time. And the part that really messes with your head is the math. When you're down 20%, you don't need a 20% gain to get back to even. You need a 25% gain. It feels unfair. It feels like the market is against you. But it's just how math works. And here's the part that decides who gets rich. Most people fail it right here. Here's what happened next, and this is where the real test showed up. When Mike saw his account drop in 2022, selling felt like the safe choice. It felt like doing something, like stopping the bleeding. And that's the trap.
because selling usually doesn't feel like giving up. It feels like being responsible. But when you sell after a big drop, you often lock in the loss. You turn a permanent hit into a permanent hit, and the market has a cruel sense of timing. The recovery often starts when people feel the least confident. That's why the stay-in years matter more than the good years. The good years are easy. Nobody needs motivation when everything is green. The hard years are the ones that decide your future. After 2022, VTI bounced back with about 26% gain in 2023 and then about 24% in 2024. So the people who sold to feel safe missed the very thing they needed most, the bounce. But the people who stayed invested, and especially the people who kept adding money during the drop, were in position to benefit when prices recovered. That's not about being brave. It's about having a plan that doesn't change just because your emotions change. And here's the part most people don't see coming. Even if you stayed in, you can still lose years of growth with one small habit. That habit is getting obsessed with tiny details while ignoring the big moves that actually build wealth. A perfect example is fees. In the beginning, I cared so much about fees that it almost slowed me down. Fees feel small. They whisper. You look at a fund and you see numbers like 0.03%, 0.06%, 0.08%, and you think, that's nothing. VTI is about 0.03%, SCHD is about 0.06%, DGRO is about 0.08%. Those differences look tiny. You could blink and miss them. But time makes small things loud. Fees don't just take money once, they take a little bit every year. And because they take it every year, they also take away the growth that money could have made. Over 30 years, an extra 0.1% in fees on a $100,000 portfolio can cost you about $30,000 in lost growth. That's not because someone steals it overnight. It's because a small leak runs for a long time.
Now, here's the myth I want to break. Yes, fees matter, but don't let fee stress stop you from investing at all. The difference between 0.03% and 0.08% is small compared to the difference between investing consistently and waiting on the sidelines. Picking a solid, low-cost fund and starting is better than staring at the numbers forever and never building the habit. And now, here's a lesson nobody expects. Dividends don't just pay money. Dividends don't just pay money. They also help you hold on. That's the part I didn't understand at the start. When your portfolio is mostly growth and the market drops, it feels like you get nothing. You just watch the number fall, and that can mess with your head. But dividends are different. A dividend is simply cash a company pays to its owners. So when you own a dividend ETF, you can still get cash payments even when prices are down. It doesn't make the drop feel good, but it can make it feel less hopeless. That's why I call dividends emotional glue. They can help you stay invested during scary times. For example, SCHD has been yielding around 3.8% lately, and DGRO has been around 2%. Those numbers move over time, but the point is simple. You see cash show up, and that cash can give you patience when the market is loud and ugly. Another thing I like about SCHD is the built-in quality filter. To even qualify, a company needs a long track record, about 10 straight years of dividend payments. That doesn't make it perfect, but it can help you avoid chasing shaky companies that look good for 1 minute and then fall apart. But here's the twist. The real superpower isn't dividends, it's how you buy. Because most people don't lose money from bad ETFs, they lose money from bad decisions. And a lot of bad decisions come from stress. That's why dollar cost averaging matters, but not for the reason people usually say. Dollar cost averaging just means you buy on a schedule, same dollar amount again and again, like $500 on the 15th of every month. No thinking, no debate, no guessing. It's not magic math, it's a brain trick. It lowers stress. It removes the question, is now a good time? You stop trying to be a hero. Mike did this after his 2022 scare. He set up automatic investing, $400 every month into VTI and SCHD. And the biggest win wasn't some secret return, it was the peace. He stopped watching headlines like they were telling him what to do. The system kept moving even when his feelings didn't want to.
Compare that to what he used to do. Wait for a better time to invest a big lump sum. Those lump sums kept getting delayed. He'd say, "I'll do it after this week." Then the market would move and he'd say, "Now it's too high," and months would pass. The best plan in the world is useless if you don't follow it. And that leads to the next mistake I made. I thought more ETFs meant more safety. For a long time, I thought dividends were just extra, like a small bonus that didn't matter. Then I lived through scary months and I changed my mind. Here's why. When your portfolio is mostly growth and the market drops, it feels like you get nothing. You just watch your account number shrink. And that can make you angry or nervous or both. But with dividend ETFs, something different happens. A dividend is cash a company shares with its owners. So even when prices fall, dividends can still show up as real cash in your account. It doesn't erase the pain, but it gives you something solid, something you can point to and say, "Okay, I'm still getting paid to hold." That steady cash can keep you from doing the worst thing at the worst time. It can help you stay calm when the news is loud. For example, SCHD has been around a 3.8% yield lately, and DGRO has been around 2%. Those numbers move over time, but the idea stays the same. You get cash while you wait. And SCHD also has a quality rule that I like. The companies in it need a long track record, about 10 straight years of dividend payments to qualify. That doesn't mean nothing can ever go wrong, but it helps avoid the too good to be true stuff. But here's the twist I didn't see coming. The real superpower isn't dividends, it's how you buy. Because even a great ETF won't help you if you keep hesitating. This is where dollar cost averaging changed everything for me. Dollar cost averaging just means you invest the same amount on a set schedule no matter what the market is doing. It's not magic math, it's a stress killer system. You stop asking, "Is now the right time?" You stop trying to be perfect. You just follow the plan, like $500 on the 15th of every month. No thinking, no guessing, just action. And that leads to the next mistake I made. I thought more ETFs meant more safety. I used to think diversification meant owning a lot of ETFs, so I did what many people do. I kept adding more. 10 ETFs, then 15, then 20. It felt like I was being safe, like I was spreading risk. But later, when I looked closer, I realized something embarrassing. Many of those ETFs owned the same big companies. I wasn't truly more diversified. I was just more complex. I was paying multiple fees for almost the same basket, just wrapped in different labels. Here's the simple truth I wish I knew earlier. Diversification isn't owning many funds. It's owning different kinds of risk. A broad market ETF like VTI already holds more than 3,500 stocks. It already covers most of the market. And because it's weighted by size, the biggest companies take up a big chunk of the fund. The top 10 holdings are about 35% of VTI, and tech is around 35% of the portfolio too. So when I bought extra ETFs for safety, a lot of the time I was just doubling up on the same names without realizing it. My portfolio looked bigger, but it wasn't really better. Now my approach is much simpler, and it's easier to stick with. One core holding for the market, like VTI, and then, if I want, one dividend-focused ETF as a tilt. That's it. One core plus one dividend tilt. Fewer moving parts, less overlap confusion, less temptation to tinker. And the biggest benefit isn't just math. It's that a simple plan is easier to hold when things get scary. And that leads to the last lesson. It sounds silly at first, but it changed my results. I used to check my portfolio all day. Morning, lunch, afternoon, bedtime. Every little drop felt like a warning sign. Every little green day made me want to optimize. The problem is, the more you check, the more you mess with it. Daily checking makes normal market noise feel like an emergency. And when things feel like an emergency, people make panic moves. They sell too soon, they buy too late, they trade more. And more trading usually means more mistakes, more costs, and more regret. I'm not saying you should ignore your money. I'm saying you should stop letting your money control your mood. I used to check all day. Now I check about once a month, sometimes less. And the funny part is, I feel calmer and I make better decisions because I'm not reacting to every little wiggle. I'm giving compounding the quiet space it needs to work. Here's the compounding stack in plain English. You need two things, fuel and runway. Fuel is the money you keep adding. Runway is time. If you only do one and not the other, compounding feels slow. But when you combine both, it starts to get real. For example, if Mike put $10,000 into VTI 10 years ago and did the simple thing, held it and reinvested the dividends, he'd be sitting at roughly $20,000 today, based on how VTI has performed over that period. But if he also kept adding $300 per month during those same 10 years, his total could be around $45,000. Not because he found a secret trick, because he kept feeding the machine while time did the heavy lifting. And one last real-life truth. Life happens, bills happen, emergencies happen. That's why an emergency fund matters. It helps you avoid selling your ETFs during a market drop just to cover a surprise expense. The people who can hold through bad years aren't usually tougher, they're just prepared. So here's your next step. If you want, in the next video, I'll do a realistic breakdown of dividend ETFs for monthly income, what makes sense, what doesn't, and how to think about it without fantasy numbers. If that's something you want, make sure you're subscribed. And I want to hear from you. What's your biggest struggle right now? Staying invested, picking ETFs, or staying consistent? Drop one word in the comments. I read every single one.